So the way that I much prefer to do it is to say, look, I do my tests on all of the assets together, combined, which gives me a really high sample size, first and foremost, which I can trust. And it proves that I've managed to produce a generalized set of parameters that work across the board. And the argument I always get given to me is that, but yes, pound dollar moves slightly differently to euro dollar, slightly differently to pound yen, whatever. So you're missing out on profit there. And my response is always, well, yes, I am, but I've got a lot more confidence.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field.
Martyn Tinsley, welcome to the show. It's been some time. I'm really looking forward to this, and thanks for coming on.
Yeah, my pleasure. It's taken us a long time to get this arranged, so it's great that I'm finally here.
It is, and I'm very much looking forward to the fact that, you know, we get to riff about trading, but also you've got a presentation for us because we've agreed you could put together a few slides once I decided I wanted to pick your brain about, you know, some of these common trader pitfalls and you know, keys to building robust strategies, having a defined process, having strict rules around how we make things robust, how we avoid overfitting. These are really obviously invaluable concepts in our world, and so it's great you've taken the time to put this together. So I do really appreciate it.
Thank you for the opportunity. You know, I think there's going to be a lot of value, hopefully, for your viewers. So
yeah, fantastic. I am sure of that. Well, look, as I like to do, Martyn, let me just ask for a bit of an intro first. Give me a bit of your background, a bit of your bio. We can break it up if you like, but how did you get into trading in the first place? Just curious about some of the early days, some of the early pitfalls, and then I'll probably ask about, you know, how you got into systematic, and I'm just trying to work out how your brain works and what your pathway was to this place. So, yeah, how did it all start off for you?
Yeah, well, I often ask myself the same question. Really, you know, I can go back to quite an early age, actually, when I started to get interested in kind of the predictive analysis space. And I was one of the first guys in my class, and we're talking over 40 years ago here, to get a personal computer. And I spent a lot of time developing applications that had this kind of predictive side to them. So at this point, I'm kind of 12 or 13 years old. So I was looking at, you know, football predictions, things like that, taking in data from the newspapers, because obviously no internet back then, and plugging that in and trying to predict based on those metrics what the score would be. And that, I think, is the first exposure for me in that kind of predictive analysis space. What then fueled and I guess empowered me a little bit more to have the right skills required for algo trading was my first job. So after university, I went to work in a research department at another university, and I was actually working with the PhD guys there, developing software applications to help them do their research. And in this space, you know, we're talking vast quantities of data, quite sophisticated kind of signal analysis capabilities around that data. And again, you know, all of that knowledge and that skill set that I got as part of doing that job really serves me now as an algo trader, because, you know, the data analysis side, the ability to take information in and form some kind of an assessment and a prediction out of that information and that data is the way I typically operate as an algo trader. So they're the two things I think that set me on that path. But it was actually many, many years later that I actually committed to trading. I didn't really apply it to the trading space at all for probably 20 years.
Yeah. You first saw a chart with moving averages on it while you were working at Siebel, I think.
I did. We were talking about this earlier on, weren't we? And I was working for a big software company, a big American software company. And one of the guys I was working with in the office, he said, "Come and have a look at this." And he showed me the stock chart of the company that we were working for. And he'd overlaid two lines on this, two moving averages. And he said, "Look, when this moving average crosses this one, price goes up. And when it crosses the other way, the price goes down." And of course, we all know it's a lot more to it than that. But that was something that just triggered something in my in my consciousness. And I then took 12 months out actually from work to travel around the world with my wife.
Nice.
And I kept thinking and coming back to this thing this guy had said to me about the moving averages. And as we were traveling around, there's no we didn't have mobile phones back then and things like that. And so I used to stop off in internet cafes really around the world, get information about technical analysis, different kind of techniques, trading techniques, and so on. I get them, print them out, and read them as I was traveling around. And it was when I came back from my travels that I actually started to put things into place to start looking at how I might apply my skill sets that I got with this new knowledge I gained to try and tackle the financial markets. It kind of started there, I guess.
No doubt you started discretionary trading back then. What was it that, created that transition? How did you go from discretionary to systematic?
Yeah, so you're absolutely right. So at the time, I always think quite naively, actually. I tried to certainly trade in a quantitative way. So it was still, I was still looking at the analysis, but then I was actually placing the trades manually. And I did that for too long, 2-3 years, I think. And it did not suit my own style. It wasn't a style that was good for me. I don't have patience, Simon. I'm one of those people that I cannot wait for the right time to enter a trade if I'm trading in a discretionary way. So I'd do my analysis, I'd work out when I'd enter, and I just couldn't wait. I'd get in early. Okay, and I'd pay the price for that. There'd be other times when I'd get up in the morning, look at the charts, and realise I'd missed an entry maybe an hour ago, and I'd still enter. I'd enter late.
Revenge trading.
So I just did not have what's the word I'm looking for? The discipline. Yeah. I didn't have the discipline to trade in that way. And I learned the lesson over a couple of years, but I still knew if I followed my rules, I would have been profitable.
Yeah.
And at that point, I thought, what am I doing here? I've got the skills to develop these strategies into algorithms. Why am I messing about with discretionary trading? Why don't I build them? And that's when things started to change for me.
Yeah.
And I started to then see profits coming in. And obviously you get to that point first where you start to break even. It's a real milestone.
Yeah.
So you start to break even, then you start to drive profits. And you just go on from strength to strength from that point forward. And since then, that's been my way of trading. I'd never be anything other than an algorithmic trader.
100%. And so you're trading today, Martyn, give us a really high level, where do you philosophically fit into the picture in terms of the markets that you do spend most of your time on, or the time frames and the strategy styles that make up your portfolio? What's the high level for you?
Okay, so I'm now a full-time trader. I don't work, and I have been for the past 6 years. And so I have a lot of time now to dedicate to the analysis side of things. And so the approach, to be completely honest, that I take is I don't restrict myself to any particular assets or asset classes. If I think there is a way of gaining an edge from a particular asset class, then I'll pursue it. I'll do the analysis, I'll do the work, and and come out with something. As it happens, most of my strategies have tended to be most profitable on currencies. So predominantly I trade 28 currency pairs, but I do also have a strategy that operates on gold. And I have actually more recently started to look at an algorithm that's based on an AI model I've developed around portfolio construction for longer term stock portfolios.
Right.
But typically at the moment, my timeframes around my normal algo trading that's live at the moment is about kind of intraday up to about 5 to 6 days in duration for trade. But as I say, I'm trying to diversify really with the stock selection and the stock portfolio side of things, where that will be much longer term. So I might sort of rebalance that portfolio once a month, something like that, based on what the AI model I've developed is telling me. So just trying to diversify really around both assets and timeframes.
And I imagine you'd be quite agnostic to the style of strategy. If something's got an edge, you'll probably pursue it, or do you have a tendency to lean toward a trend following camp or a mean reversion camp, or is it any of the above?
Well, certainly from the perspective of what I've found is the easiest kind of strategy to develop, they're usually based around mean reversion concepts. So I have a lot of strategies, the bulk of strategies probably around mean reversion concepts. But also, I have some breakout, some other trend following strategies. I've even tried pairs trading in the past, but didn't have much success with that. So I don't have anything live at the moment in that pairs trading space. But yeah, absolutely. I try to diversify, try to have as many different types of strategy as possible because, with different market regimes, obviously when some strategy types are doing well, others aren't, and then things change and it's the opposite. So the ability to have a range of strategies that operate together in the same accounts helps to
smooth the ride,
smooth out the equity curves. But what I found, easiest to develop have been the mean reversion type of strategy.
Now, I can't get you on the show, Martyn, and not ask about Darwinex, because anyone who knows YouTube, probably knows your face from being the face of Darwinex for, well, I don't know how long. You could tell me.
Maybe 5 years, actually. Yeah.
Mm-hmm. And I'm quite happy to continue the conversation we were having offline too about the reality of commercializing trading and the nature of prop shops and that kind of thing. But I guess tell people what Darwinex is and give us a few of your learnings from your time there. And then for people who do want to think about commercializing their trading, what are the options on Darwinex, and are there some things that you can do and can't do and should know, and if you that kind of thing. And I guess just to add a bit more context to this too, like I've mentioned this to my community recently, that it's a very viable thing to consider if you're getting into trading or you're trading well, is to have a plan where you could imagine trading external capital. It's a really logical way to actually generate increased returns from your trading. And what I like about it as well, is that the pressure comes off a little bit from trying to make those unrealistic returns and becomes a little more institutionally minded about, well, let's just make consistent returns and survive, and you can do very well with that. So, I mean, they're my 2 cents, but going back to, tell us about Darwinex, what it is, your time there, and let's talk about commercializing trading.
Sure. Yeah. Well, you've made some really important and valid points there, I think. And just to be clear, before I ever worked for Darwinex, I was a customer of Darwinex. In fact, I was one of the first customers. So when Darwinex first, started to make their offering available, I think I was kind of trader number 10 to join the platform.
Yeah, wow.
And by the way, still am, and a trader with Darwinex, and very much an advocate for what those guys are trying to do, because they really distinguish themselves from other participants in the space. And so it's probably worthwhile saying what Darwinex does first of all, because I'm sure there'll be people who aren't aware of that. So Darwinex acts as a regulated asset manager, and they enable skilled traders to come onto the platform, and they provide a mechanism where they can join those traders up with investors, with real investors coming into the platform who want to invest in trading talent. But Darwinex operate as that regulated asset manager in the middle. Okay, so from a trader perspective, what it means is that I can be completely legally attracting investor capital without having to be regulated myself. So it's a real great opportunity for traders, as you put it, to commercialize themselves and to commercialize their efforts to really increase the amount of revenue that they're generating. And you made a really important point. It takes the pressure off. Okay. If you're only trading your own capital, there's always that pressure to start, upping your position sizing to try and make more money. And if you go too far, you start to over leverage and you risk effectively bankrupting yourself, because it only takes one really bad drawdown. And if you're over leveraged, then, that's a prime case for bankrupting your account. And we all hear of traders who do this again and again and again. With Darwinex, it's different, okay? You can keep your position sizing really realistic, because if you're successful, you won't make the majority of your money from your own account. You'll make the majority of your earnings from the performance fees you get from investors. So the way it works is that any profit that investors get, they pay a 20% performance fee. 3/4 of that goes directly to the trader, and 1/4 goes to Darwinex for acting as the regulated asset manager.
It's such a good model in an over-regulated world where it is so difficult, like to actually launch a hedge fund, especially in my country. The regulatory costs are just prohibitive, and so I love the fact that these alternatives have come online. And there's a few ways, there's a few alternatives out there. And the other ones are like the pod shops, or not the pods, but the prop firms where, you can also come in and trade their capital. It's slightly different, right? It's their capital, not necessarily external capital. And, we were saying that we're not really impressed with the way the vast majority of those operate.
So it's worth saying that the models are completely different, okay, between what Darwinex is not a prop firm. And fundamentally, the difference is that with prop firms, they are relying on traders, on the majority of traders actually losing money in order for them to make money.
Yeah.
Okay. So the kind of the objectives of the trader and the prop firm, they're just loggerheads with each other. They're not the same. With Darwinex only profits when the traders are profitable. So there's complete alignment there. Darwinex wants its traders to succeed. Prop firms typically don't, because they wouldn't make any money if they did. Okay, so that's the reason actually that prop firms put so many restrictions in place around drawdown limits, around all these other things that could potentially cause traders to fail and then have to resubscribe again to get a new account. Okay, that's how they're making their money, by churning those traders. With Darwinex, they put no restrictions on how the trader actually goes about their skill. So they say, look, you trade how you want to trade, how you think is best to trade. And if you're good enough, you'll attract investor capital and you'll make a really nice living. That's the difference. There's complete alignment. So it's like chalk and cheese, comparing a prop firm with Darwinex. You're absolutely spot on.
Yeah, it really is. All right. That's wonderful. Really appreciate that. Was there anything else that I missed? Did you want to say about that Darwinex thing? I can't recall if there was something else we were going to say.
Well, there's just one more thing I will say. Okay, yeah. So Darwinex have two offerings. Okay, so depending on where your viewers are, if they're looking at Darwinex, if they are already profitable, then Darwinex has a full brokerage offering where you can trade your own capital and, of course, risk your own capital. And that track record is then used to attract investment if it's good enough. Okay. But what Darwinex also offer is another offering called Darwinex Zero. And the zero here means zero risk to the trader. So what Darwinex do here is they give you a virtual account. So if you've got traders who are kind of break even, they're not quite profitable yet, this gives them an opportunity to start building a track record without risking their own capital. And then once they get profitable, they can then migrate that over to a full account. So there's a kind of a journey there to help traders on their own journey to become profitable and investable traders.
Yeah, I think, was it a couple of years ago or not quite that long that Darwinex introduced this mechanism where you can just continue to trade on your Interactive Brokers account as you would today. They'll connect into it, they can pull your track record, and then you can continue just to trade on your account. And it makes
so that's right. So initially it was just MetaTrader MT4 and MT5. And they do have now this offering for Interactive Brokers. So you can either open up a new Interactive Brokers account, or I think you can, take your existing account and kind of migrate that over to Darwinex. Yeah.
Well, anyway, Darwinex, if you want to sponsor this show, you can. But at the moment, they're not. So yeah, just our
and
personal
I have to say,
thoughts.
I don't work for Darwinex anymore. Okay, but I'm just a huge advocate. I believe in what they're trying to do. Yeah. And I believe what they're doing is the right way of going about things, because it helps traders like me and you to become credible traders and earn revenue.
Yeah, 100%. No, I like what they're doing too. I have spoken to the leaders there in the past and a couple of the guys that you know. And so we might try and get some of their star traders on the show. We'll see what we can do there. All right, Martyn. Well, thanks heaps. I think we should move into the presentation and get into what you've got for us there. Let's get into the meat of it. Really looking forward to this.
Traders, crypto is not a wild, unruly market. It's an asset class with 500% more time for price discovery and opportunity. My new course, Crypto Trader's Edge, is now live through Algo Advantage, one of the top quant pods and academies out there. A full systematic framework, backtesting, strategy development, validation, real edges with full code, not hype. Links in the description, or head to my Substack at Rectelligence. Now back to the show.
Sure. Okay. So I want to start with what I think is possibly one of the biggest pitfalls and the biggest misunderstandings, really, that certainly, I speak with a lot of traders. So every week I'm talking to traders, going through things. I do offer consultancy, and it's pretty much the traders that come to me all have similar misunderstandings about the data they're seeing and similar misconceptions about what they should be doing and the approach they should be taking. So hopefully you can see the chart I've got on the screen there. I want to just use this. This is just, it's made fake data, but just to illustrate the point here. So it's really simplistic, and I want you to imagine, Simon, you've done an optimization on a particular parameter, okay? It could be anything. It could be a moving average, let's say. So you've been doing some work to see how, maybe a moving average affects the directional bias of a particular strategy. So along the bottom here on the x-axis, we've got the parameter values that you've tested. And then on the left-hand side, on the y-axis, you've got some kind of measure of performance. So I've just used Sharpe ratio as an example. Now, the line that the curve that I've drawn on the chart there represents, if you like, what is the true edge of that particular strategy or parameter. Okay, so as you can see here, we're looking probably at a value of about 65 as being the optimal for this particular parameter, be it a moving average or whatever. But we're looking here at what is the genuine edge of this parameter. Okay, unfortunately, life isn't that easy. And when you see charts, you don't see nice charts that tell you what the edge is, because different things get in the way and distort the information. Now, as an example, economic news is one of the most major aspects of any backtest or optimization that gets in the way of giving you the information that you really need to make decisions. Okay, so let me give you an example. So we can see here that the parameter we identified that actually has the best edge, when we get to a point of looking at that in reality and the real results of the backtest, as you can see, the parameter with a value of 65, it doesn't come out that well, actually. And this might be because it's been negatively affected by the effects of economic news. So what does this mean in reality? So all of these parameters will have different positions open in the market at different times. And if you've got a strategy that maybe where the positions last for 3 days, 5 days, 7 days, however long, during that period of time while a position is open, it's going to have lots of, it's going to be impacted by lots of economic news that is occurring during that time frame. So, some of the biggest market movers, Fed interest rate decisions, non-farm GDP results, and so on. These all impact the market, and they'll either cause the asset that you have a position open in to go up or go down. And it's more or less kind of chance as to which way they're going to go. Unless you've got inside information, you do not know which way a particular piece of economic news is going to make the market go. So in this particular example, our optimal parameter of 65 just happened to be negatively impacted, which means that maybe if this was holding an asset long, the economic news, more often than not during your backtest period, affected it negatively and went against the trade. Okay, and so that has the effect of pushing the perceived performance down. And if we look over here, for this parameter that has a value of 50, this was nowhere near as good in terms of the true edge of the strategy. But it's the other way here. This just happened to have positions open at times when, by chance, they were positively affected by economic news. And so that has, if you like, made this parameter value look better than it really is. Because this here is if you're trying to measure the edge of the strategy, this is how it performs. So this one has been elevated and this one has been demoted. Okay, and so you don't get, as an algo trader, looking at the results of an optimization, you're not being told the information you actually need to make the best decisions. Okay, now this is critical, and this is a really important thing to remember. Things like the reaction of markets to economic news, they are non-repeatable events. So if you're making a decision from backtest data that's been influenced by that, when you go live with a strategy, you can't expect, just because something did well in the past because it was affected by economic news in a good way, you can't expect that same thing to happen in the future. It's pretty much going back to 50-50. It might be by chance, or it might, disbenefit from it by chance. However, it's different when you talk about the true edge of a strategy, because that is something that is repeatable. If you perform a backtest and you're able to identify parameters that have genuine edge, when you then trade those in the future in your live account, you can expect that edge to persist and to be able to make money in your live account, providing that market dynamics don't overly change. Okay, if market dynamics stay broadly similar, you can expect that edge to be repeatable in the future. So one is not repeatable, the other is. And so the challenge as algo traders, I should just say here, so if you've got a list of optimization results, like the one here, the fact is that the parameters that appear at the top of that list are probably at the top of the list because they've been favorably impacted by economic news. No other, there'll be some element of edge in there as well, but they're there because they've been positively affected. So just by choosing the top performers in an optimization and then trading those, you cannot expect them to trade as well in the future as they did in the past. And that is the key, I believe, what I've just explained is the key reason for that.
So let me just play catch up and make sure I'm following along. If we go back to the previous slide, so what you've put up, and some people will have audio only, get on Spotify or YouTube if you want to watch the slides. So there's the initial chart, shaped like an upside down U, high point in the middle. So this is basically, you're kind of like running an optimization on a single parameter and saying, well, the value of 65 or so gives you the best sharp in a backtest.
Yeah, exactly.
Now, in reality, what can happen is that there can be other factors, noise, news, and so on, that means that, of course, that particular parameter value may or may not actually deliver the expected result, because there could be an upward or downward impact of news, say. Is a way of framing this as saying, well, we want to find the real factor involved in producing the alpha and strip out the noise. And
Exactly. Yes. Yes. You have taken the words from my mouth. Okay, that is exactly what, over the last few years I've been working on trying to achieve. Yes. Yeah.
Right.
So it's filtering out those elements that are not useful.
Yeah.
And retaining the elements, i.e. the indication of edge of the strategy, keeping those in. So yes, absolutely right, which then helps to deliver alpha in the future because you're making better decisions. So have you got any more questions, or do you want me to move on?
Just one more quickly. Were there any key names, people maybe, that influenced you when you first started having these thoughts? Because I'm just thinking about John Eller's or Kaufman's efficiency ratio, or things where people are making this case of trying to find the signal in the noise through various methods. I don't know, was there an influencer, someone that got you thinking about this? So I know that's an odd question, perhaps.
Yeah, so the biggest influencer by far is Perry Kaufman.
Yes.
Yeah, you said him, right? So I've got a bookshelf there which has got all of his books on, and the guy's a genius. He's a rocket scientist, right? He worked on the Gemini missions and all of that. This guy knows what he's doing with data, and Perry was a huge influence. And also, actually, I am a massive advocate of the Kaufman efficiency ratio. I love it. It is brilliant, but it doesn't provide a solution to this problem I'm talking about.
All right. Okay. Well, I will let you go on, but I will put a little advertisement in here, because I'm working with Perry to produce a trend following course for Algo Advantage. So keep your eyes open for that in the future.
Yeah, so I've spoken to Perry on a number of occasions myself, and I think anybody should tune in to those Perry Kaufman sessions with Simon, because the guy is just full of such useful information. And I'd encourage anyone, and I certainly will be tuning into that.
And of course, he was on the pod. I can't obviously remember off the top of my head what episode it was, but it's a fantastic podcast with Perry. He is a lovely guy and has an enormous amount of experience. So go back and watch that episode with Perry if you haven't seen it.
Yeah. So I've learned so much from his books, and if there's any viewers who don't have those books, just get them. Some of the books are a bit expensive, but they're worth every single penny. And the thoroughness that he uses to explain information and techniques is just beyond what I've seen with anyone else. So anyway.
All right.
So moving on through here then. So we've got what we need to do, exactly as you said, Simon, is take this rather erratic kind of light blue line that we've actually got in our optimization, and we need to make it more similar to what we're actually trying to identify, which is the edge. Okay. Now, in this example, I've kind of represented what that might look like. And so now, instead of choosing that value of 50 that we were before, that didn't actually perform so well, we're now much closer to the optimal of 65. And we're choosing now this value of 70 because that's the kind of the most robust value, if you like, from the chart we now have. But of course, the key to this is, well, how do you do this? So what I have, from the research I've undertaken, is that I've come to the conclusion that the strategy's edge that you're trying to target is relatively smooth. Okay, it changes gradually across the optimization space that you're looking for, and that kind of makes common sense as well, because why would you expect it to be up, then down, then up, then down? You'd expect the genuine edge to change gradually across the optimization space. And I always like things that make common sense, because to me it says, well, if my research has shown this is the case and it makes sense, then that's good. However, what you will find is that the effects of distortion from noise and economic events is much more erratic. Here, you'll find that it is up and down, because different parameters get affected by non-farms just because they were holding long at the time, other ones negatively because they were holding short at the time. And you get this erratic nature to the data that you're presented with from the optimization. So you've got another way of looking at it is low frequency changes and high frequency changes. And I always like an analogy. Okay, and the analogy I have here is something that certainly anyone who produces podcasts or any kind of audio will be able to relate to immediately. When you record audio, there are two components to it. You've got the sound that you actually want, someone talking, music, whatever it is. And then you have this other element called white noise, which is the background hiss.
Yeah.
And the background hiss is high frequency, very, very high frequency noise. And the sound that you actually want to retain is much lower frequency. So you can use a technique called a low pass filter. It's a sound engineering technique, also, electronics technique. And what that does is it allows the lower frequencies to persist, but gets rid of the others. And through that and an element of smoothing as well, you can actually reduce those effects of noise and economic news. Okay. So let me give you a real example. So this is kind of data I just used to illustrate the point. But if I bring up, so I used to do all of this manually, by the way. It used to take forever. I've now developed this into a software application, which I use myself, but also I do make this available to other algo traders as well.
Yeah.
So what we have here is, if you like, the raw results from an optimization I performed. So here we're looking at two parameters simultaneously on a 3D surface.
Yeah.
And you can see here that, it's really erratic. And if you were expecting to make any decisions over, what's the best kind of area, what's the most robust area on this surface?
Yeah. Where's the stability? Where's the smooth part of the surface? It's very jagged. There's a lot of noise. Really
jagged, a lot of noise. And normally you won't maybe have quite as bad a surface as this. I've chosen this because it is particularly bad and particularly affected by noise. And in this particular case, the reason for that is because the underlying edge of this strategy is actually very, very small, if there at all. Okay, and this is just an example algo that's come with a trading package. It's not meant to be a profitable trading strategy, but because that edge is so small, it means that the effects of noise in relation to that are much bigger, and so you get this really jagged, unintelligible mess of data. Okay.
Yeah.
But so I have this technique which I call it intelligent edge detection, and this is doing that process I just talked about. It's smoothing, and it's using that filtering to filter out the noise. So if I turn this on, you can see now you get a much clearer picture of what's actually going on behind the scenes. You can see, well, you've got a really bad kind of area down here, and you've got a kind of, a number of peaks on this side that you just couldn't really see before. And so through this process of filtering out, you start to be able to identify, okay, the important data, which is that data that is likely to be repeatable in the future. After you've chosen the best parameters, you would hope they would continue to be fairly optimal in the future. Okay, so that is, if you like, that's the first of 5 areas that I wanted to talk about. And I guess if you wanted to sum that up, it would be the fact that noise and these undesirable effects of the market hide the real edge of your trading strategy and hinder your ability to make good decisions on that data, on those results. And so through this process, I think I've come up with something that by no means is perfect. There's always going to be some element of noise in your back tests. Let's be clear. You're never going to get rid of that. You can see that here. There's still some noise.
Yeah.
But the more you can reduce it, the better informed decisions you can make.
Right. So, Martyn, what I'm getting out of this so far is, and correct me if I'm wrong, but what I like about this is that you are, you're not trying to select the best after the fact. You are in the research phase here. You are priming the data, as it were, so that the data is in a better position to give you real answers, because you're in this research phase, and this is something I've been talking a lot about as well, like staying in this research mode longer rather than jumping into a strategy and pressing optimize. So you're defining your research goals, as it were, and you're aware of the fact that there's noise that's getting in the way of the analysis. Therefore, you want to apply this post-processing of the data to put the data in a better position to tell you a better story. Is that a good way of saying it? Am I covering the bulk of it? Are there other aspects to this?
Absolutely right. So there are multiple reasons why you might perform an optimization, and you might be doing a final optimization on parameters before you go live. That's kind of not what I'm talking about here. So what I'm talking about here is you might be at the stage where you're researching some kind of a filter to identify if that filter has a genuine edge or not, and actually helps your strategy. So while you're in that research phase, being able to look at the data in a way that filters out all of that noise, it will help you come to those conclusions in a much better way as to whether, yes, this does offer value to the strategy, or maybe no, it doesn't. Okay. Whereas with all of that noise in play, if you're making decisions based on that, you might be making the wrong decisions, and you might come to the conclusion that something is valuable to the strategy when it isn't. It just happened to get positively affected by news, and that's not what you want to be making decisions based on.
So we're dealing with overfitting traps, and am I right to say that probably all of the points that you're going to raise are broadly speaking under this category of how to avoid overfitting?
Yeah, I think most of them are actually, and I guess what I'd say there is that overfitting is a huge topic of conversation, and every algo trader has this idea of what they maybe think overfitting is, or they might just think it's bad. And what I think actually, is in play. People talk about overfitting without getting into the nitty gritty of what it actually means and what actually causes overfitting. So what I'm trying to do, I guess, with some of the things I'm going to be talking about in this podcast is putting some meat on the bone of that.
Yeah.
And actually coming out with something that, this is what it actually means in a practical sense. These are the things that are happening in the background that cause it. And hopefully these are the things that I'm saying you can kind of do to get around them and to alleviate them to some degree. But yes, I think, overfitting is a big problem. And what I'm trying to do here is really quantify what overfitting, or what the different elements of overfitting are, because there's many.
All right. So smoothing the data, trying to separate the noise from the factor, the real edge contributor in the data. What else have you got for us, Martyn?
Well, I guess, staying on that theme of over optimization, it really brings me to, I guess, one of the first things I realized really early on in my journey as an algo trader, that is the real big killer, and that is statistical significance and sample size in the research and analysis that you are doing. So I actually, probably, I think about 5 or 6 years ago, decided to perform some fairly in-depth research into, what kind of sample size, and by sample size, I'm talking about, the number of trades that a trading strategy produces in that in-sample stage of your analysis. Okay. And you can tell, so that's me in the corner there. This is actually a screenshot of a video I produced.
I think I've seen this video.
Oh, have you? Yeah.
Yeah.
And this was, even though I knew what I was setting out to do with this research, this was a huge eye-opener for me. And it really moved me along in terms of my understanding of what was required to produce statistically significant backtests that you can actually trust the results of. Okay. And I tell you, I must have 3, 4, 5 people every week who contact me and say they've just seen this video and it's completely changed the way they look at backtesting now.
Okay, so walk us through it.
Okay, so I'll. It looks like a really complex mess, that, but let me talk through what my methodology was and what I was setting out to achieve. So, if you go onto trading forums, you try and research information about what is a statistically significant number of trades so that you can look at a backtest and believe those results. There's an incredible, I think, naivety out there about how many trades you do need. And many times on many forums, there are traders who say, you're going to have at least 50 trades for it to be, statistically significant enough to look at the backtest and say, yeah, that's genuine results. And that never sat well with me. I'm like, 50 trades just does not sound as though it's enough trades to be able to trust a backtest. So I set out on this mission to come out with something that was more quantitative and based on actual research that gave me more of a definitive answer. So let me tell you, I thought long and hard about how do I do this? And the methodology that I eventually came up with was to take a simulated strategy that had a particular level of edge. Okay. And the way I did it was I had equidistant stop loss and take profit on a particular strategy. And I engineered one of the permutations of the strategy to exit at the take profit 10% more often than it exited at the stop loss. So in other words, 55% of the trades would be profitable, coming out at the take profit. 45% of the trades would be loss-making, exiting at the stop loss. And then for all of the other permutations that I was looking at, it was 50-50. It was completely random, okay? So the red line that you see here is like a simulated backtest using that 10% of edge. Every other line that you see is completely random, okay? And what you see is that there are, out of those random permutations, there are examples that lose money, there are examples that win money, and there are examples that break even, and everything in between. So this is a simulation. Okay, so right. This is a simulation.
It's just a simulation. It's not stock data. It's not market data.
Yeah. Not at all. It's a simulation of saying, look, these strategies have a 50-50, these parameters or permutations have a 50-50 chance of either winning or losing. Let's run that through a simulator and see what kind of equity curves they produce based on complete randomness. Okay. Yeah. Whereas the red line we see here, well, that isn't. I've specifically engineered that to have a positive edge.
Yeah.
Okay. And it's pure simulation, but that achieves what I needed to get out of this. So if you look at the right-hand side of the chart, so obviously they all start out at the same point, okay, with the same amount of equity. You then run through all of these permutations, and what you notice, okay, the red line that has the edge is overall profitable, but, and this is the important point, there are random strategies that performed better than the strategy that had the edge. Okay, so in this particular example, let me just look. This is 500 trades. Okay, so each of the permutations has 500 trades, and after 500 trades, there are 1, 2, 3, 4, possibly 5 of the permutations that were completely random, that performed better than the strategy that has a genuine edge. Okay, and that should be worrying to any algo trader, because think what that actually means. If you had run an optimization and some of your parameters did have an edge and you're trying to select those, and other parameters don't have an edge at all, maybe they're break even, just because of randomness, you might select a parameter set that has no edge. That's what it means. Okay, that's really, really important. And that's what happens with low sample sizes. So let me go on and show you a couple of other examples here. So this is another one. Okay, so you can run this thing through as many times as you want, and every time it will give you different results. So here it's even worse. You know, the thing that has the genuine edge, it's barely profitable, if at all now.
Have you run this through more iterations now? Is this longer or just a different run? Still 500 events?
This is a different run, but still assuming there are going to be 500 trades at the moment.
Okay, yep.
Right. So this is the same, still 500 iterations, but the strategy with the edge fared a little bit better here. You still wouldn't have chosen it if you were choosing just the highest value, because there is one random strategy that just happens to perform better. But you're much closer to actually selecting it. Okay. Now, this is the key chart. What we're looking at here is how this plays out now over 2,500 trades. And what is clear is that the bigger the sample size and the longer you give a strategy to actually show its full potential, the more it will distinguish itself from random parameters that have no edge.
Yes.
Okay. So it's extremely clear here that one of these strategies has an edge and the others are kind of just random. That's really clear. But you couldn't see that with just 500 trades.
Yeah.
Okay. And if you look back here on the chart, 500's about kind of here.
Yes.
And you can see, you know, there are some that are still outperforming it at this point. But but over the long run, it begins to show itself and show its full potential. And that's the key thing.
We've made this point before too, but it makes me think of all the fund managers sitting around in those early years. They're having, really they've done less than 500 trades, and all their peers have done 500 trades over the last, could be quite a number of years. And they're all at that point still indistinguishable from noise, really. And
exactly. And the kind of conclusions that I at the time drew from this and still hold by the way, is that for a strategy that has this kind of level of edge, and I've termed it, it just basically just 10% more of the time is profitable than it is loss making. So it's the 55-45 split. With that level of edge, my belief is that you need about 1,000 trades to have confidence in the results that you're seeing. Okay. Now, what I've proven with this analysis is that if you have a bigger edge, if you develop a strategy that has a better edge than that, you need fewer trades to have the same level of confidence. So with a strategy that has a really great edge, you might then only need 500 trades to have that confidence level. But if you have a strategy that has a weaker edge, you might need 2,000 trades or 5,000 trades to have the same level of confidence. So it all depends on how good the strategy is that you're developing and researching as to what you actually need. So there's no single answer to what sample size needs to be. to give you that statistical significance. It depends on the edge, but hopefully what I've conveyed is the principle here. As you can see, from this curve, this long-term curve, this 10%, it's not half bad. Yeah, there's some drawdowns in there, but it's not too bad. It's pretty good. So even for something that produces that kind of result longer term, you still need about 1,000 trades. And I have traders who come to me for advice all the time, and they'll say, I've got a strategy that works on pound dollar. It doesn't work on anything else. It works on pound dollar, but when I put it live, it kind of it loses money. And when I take a look at the back tests, they might have 60, 70 trades. Yeah, and what I say is it's nowhere near enough to be able to have any confidence in your back test. None. So, it doesn't surprise me at all that when they put that live, it doesn't make any money or it loses money, because it probably never had any edge in the first place.
You've given away...
We've been deluded.
Yeah, and you've given away a good example there of how to get more trades. Is you said they looked at only one market. If you can run a strategy across many, many more markets, you're giving yourself more data points, aren't you? And
you are.
Helping
in fact,
to validate.
I was going to talk about this maybe in the second session, but I'm thinking on the fly now and thinking maybe it would be better and make more sense to bring that forward into this session. And probably, given the time so far, that would be the kind of final thing we'd look at. But I think it would be sensible for me to just briefly cover that now, if that's all right, Simon.
It sounds good. Let's do that.
So coming back to the point you rightly just made, there are things you can do in order to increase the sample size and therefore statistical significance of the results you're seeing. And, relatively easy ways of doing that are, as you said, by increasing the number of assets that you're performing your analysis on. But also, I found it really beneficial to look at multiple time frames as well. So my view is that on the whole, strategies, if they have a genuine edge, they should work on multiple assets, and maybe within an asset group, but also potentially even across different asset groups. And so anyone who says they've developed a strategy and it only works on dollar yen or it only works on the S&P 500 or whatever it is, I'm always very skeptical that because they've done that, they probably haven't got much data. Their statistical analysis is probably suffering because of that. And so I'm always extremely dubious about whether they have any kind of strategy at all. There is one exception to that for me, which is when someone has gone out to develop a strategy that is specifically targeting a unique characteristic of a particular asset, and they've managed to do that, then that's the kind of the exception. Okay, so if you look at dollar yen tends to have good trends that seem to be able to be captured relatively effectively with trend following strategies, much more so than some other currency pairs. And so if you're targeting something that's very, very specifically looking at an aspect of the price action or the characteristics of how that price action moves, then I'm kind of okay to accept that. But if you've just developed a general strategy, like a mean reversion strategy using some kind of indicator, and that only works, you tested it on 28 currency pairs and it just happened to work on one of them, that I'm not comfortable with. For me, that's randomness, and you haven't really probably got a strategy at all. So generally speaking, I like to see, if I develop a strategy, for example, so I do trade currencies, and I typically trade 28 currencies, which is the crosses from the 7 major currencies. I'll want to see a strategy work on at least 50% of those currency pairs. So that's what I'd be looking for anyway. That kind of, does it work on at least 50% of the assets I've tested it on and that I've researched.
And what does work mean? Like, do you have so say you're testing an idea for dollar yen or for currencies, say, and you have this rule that says, I'm going to try the same thing on all the other markets. It should work on more than 50%. Do you expect less of it, like potentially that, maybe it will shine in, say, because if you think of the futures markets, for example, you've got currencies, you've got commodities, you've got softs, metals, and so on, equities. If the strategy is expected to do equally well on those 50%, that could be asking a lot, or do you have a sort of a lower threshold to say, well, look, as long as it passes these bars, then I know that I'm generalizing. This is going to generalize well.
Yeah. So if I developed a strategy for a particular asset, which, by the way, I don't tend to do, it's not the kind of thing I do. Yeah. But if I had, then I probably wouldn't even test it on anything else, because if I was, targeting a specific element of price action, then it's probably not going to work on anything else anyway. But from the other perspective, so I like more generalized solutions. I will start out from the very outset trading or researching it on 28 assets, for example, from the get-go.
Yeah.
And I'm kind of, the approach I tend to take is that I will, if I trade a strategy on, let's say I end up trading a strategy on 20 assets, I'll use exactly the same settings for all 20 assets. Okay. What a lot of traders will do is they'll optimize against euro dollar, and they'll trade euro dollar with a certain set of parameter values. They'll then optimize separately on pound dollar, and they'll tweak the parameters that are used to trade that. But for me, that is just introducing overfitting again. So the way that I much prefer to do it is to say, look, I do my tests on all of the assets together combined, which gives me a really high sample size, first and foremost, which I can trust. And it proves that I've managed to produce a generalized set of parameters that work across the board. And the argument I always get given to me is that, but yes, pound dollar moves slightly differently to euro dollar, slightly differently to pound yen, whatever. So you're missing out on profit there. And my response is always, well, yes, I am, but I've got a lot more confidence in the strategy that I'm, if I'd optimized to each of those assets or asset classes, I wouldn't have the same level of confidence in the strategy. It's simple as. And I would think to myself, I've overfitted here, or I've potentially overfitted. But by taking the approach I take, yes, I might not be targeting specific price characteristics, and so might be losing a little bit of profit there, but I'm a lot more comfortable trading it because I have a lot 100%. More. Yeah.
And will we come in the part 2 to maybe some of the metrics that you look at, the way you're sort of building a quote-unquote objective function of coming back to this word work, right? What a strategy works. Like, can we come back to some metrics around what you look at to define that it's working? Yeah, okay, great.
In fact, that was actually going to be the final thing I did today. But then, based on the way our conversation went, I thought this maybe made more sense to do it today.
Yep.
So I think the first thing
keep them hanging for part two. All right.
So I mentioned then, as well as this ability to diversify across assets and asset classes, it can also be very powerful to look at how strategies perform across multiple timeframes. Now, again, there's a kind of a caveat here. There will be some strategies, let's say some day trading strategies, where you will devise a strategy that trades at the market open and closes sometime before the market close that day. That's not the kind of strategy I'm talking about here, because clearly with those, in the very nature of the strategy makeup itself, you've kind of decided, well, look, every trade's going to last less than a day, and we're going to open pretty much at the beginning of the day or not at all. And then if we did open, we close at some point that's preferable when we've seen the market move that we anticipated. I'm not talking about that kind of strategy. I'm talking here more about maybe swing trading strategies. So you might have developed a mean reversion strategy that might keep you in the market for 3 days. It might be sometimes be 5 days or even more than a week. And when you look at those types of strategies, you can then feasibly say, well, if we're using some kind of overbought, oversold measure on, let's say, an hourly chart, let's see how it performs if we look at that same overbought, oversold measure on a 4-hour chart or on a daily chart. And very often what I found is that if you've got a strategy that does have a genuine edge, and you've proved that in a statistically significant way, it will very often work on other timeframes and produce relatively uncorrelated positions in the market that you can trade alongside each other. So, for example, you could trade things that came from a signal on a 1-hour chart in the same account as that same strategy working on a daily chart. And because those time frames are sufficiently different from each other, they should create uncorrelated trades, which then, of course, if both are profitable, it helps your return, it helps reduce your drawdowns, because you may well have, a trade in Aussie dollar in the 1-hour time frame that's long, and have a short Aussie dollar position from the 1 hour. And so they kind of, net each other out for the period that they're both open. And generally that has the effect of reducing drawdown overall. But what it also does is give you that added confidence that you are looking at statistically significant results. Because if you have a strategy that maybe has 5,000 trades that are generated from these 28 assets in the 1-hour chart, that's great. But as you go up the time frame, your trade numbers reduce dramatically because you get a lot fewer signals. So by the time you're in the daily time frame, you now might only have 600, 700 trades compared to 5,000 that you got in the hourly time frame. And so on its own, if you were just using that daily time frame and nothing else, you might look at that and say, have we got enough trades there to be statistically significant? But if you've got the backing of the fact that that works as well in an hourly time frame with 5,000 trades, that can give you that added confidence.
Yeah, so there's kind of two things you've covered there, if I got that correctly. One is as a testing mechanism, as a robustness testing mechanism, you can confirm that the logic applies, that the edge is found on different timeframes. And the second part is the actual ensemble application, where you can deploy multiple strategies on different timeframes in order to get better risk-adjusted returns. Is that right?
That's exactly right. Yeah, absolutely. Yeah. And there is just there's one final point really that I kind of want to make, which is something I've I talk a lot about these discussions I have with different traders, and another topic that I've heard maybe not come up quite as often, but certainly enough to mention this, is that traders that I've spoken to often optimize on the time frame. And what I mean by that is they might, they've developed some kind of sophisticated technique within their algorithm that is able, in a single backtest, to trade multiple time frames.
So like a bar size of 15 minutes, an hour, a 2-hour bar, a 4-hour bar, run the back test on all of those different bar sizes. Yep.
Exactly. And what they come back with is, and it was the hourly time frame that was the best, so that's the one I'm going to trade. And the first thing I say is, well, I personally think that's the wrong way to approach this. Yes, you can optimize on some things, like the periods you're using for a trend filter, for example, or the level at which you're measuring an asset has become overbought or oversold, in which case where will you enter. These are logical things to perform an optimization on to determine what the optimal way of running the strategy is. But to optimize on time frame kind of doesn't make sense to me. For me, a much better approach is, if you've optimized and all time frames are profitable, don't just choose the best one. Choose all of the ones that have an acceptable performance based on what your own criteria are. Because then you can, logically, if those time frames, as I said before, are enough apart, you can trade them in the same account and actually get some level of diversification there, added ability to manage risk, reduce drawdowns, and everything else. So it doesn't make sense to, and I thought it was worth mentioning because a number of traders have said they've done this to me, and it's not an approach that I think is a good approach. So there you go. That's me done, I think, for today.
Yeah. Awesome. No, I agree. To optimize across different bar sizes and come out with the 15-minute and say, well, I've found an edge on the 15-minute bars. I mean, it sounds a little bit compelling to a new trader, but I guess it comes back to this thing too of the benefit of being able to explain what your edge is and why. Why do you have the edge there on that bar size and not on the 20-minute bar? You're asking for trouble.
Yes.
All right. Well, Martyn, that's awesome, man. Yeah, I reckon that we should just keep plodding through in part 2 and cover this, the other points that you've got. I'm really keen to tie it together into this kind of process, to see it sequentially of these different process steps that you would go through. And I'm thinking about some of the stuff we can talk about with the members in the bonus section as well, which will be very interesting. And plenty more to get through. Hit on your trading a little bit as well to give some further context. But, mate, so far this is fantastic stuff. So looking forward to part 2.
Yeah, I just hope, there's been some value in there for people, and I've maybe made people think about things in a slightly different way than they have done in the past. And if I have, that's great, fantastic.